Well, this is Current Yield Grant's Interest Rate Observer of the Air, and I'm Jim Grant, and joining me, as always, is the great Deputy Editor of Grants, Evan Lorenz, and today we have a very timely and special guest in Julian Klymochko, who is the world's leading authority on the world's leading speculative investment, the SPAC. So before we get into this, I would like to put in a plug for the first read of the day. The first read of the day could be DelanceyPlace.com, DelanceyPlace.com, which is, I don't know, it comes to you in the magical way that these things turn up in one's inbox. And Delancey Place delivers every morning, unbidden, unless, well, you bid for it by signing up, but it arrives, and it's like an 800-word excerpt from a book. And recently, the Delancey Place people have been on kind of a financial history jag. And this morning's excerpt is, Julian, I think you will agree this is exceptionally timely. The title is Ancient Legal Thought by Larry May. Came out in 2019, I guess. And what is especially apropos about ancient legal thought is that part of the Code of Hammurabi dealing with debt forgiveness. Debt forgiveness. That's kind of a thing now, right? I mean, we read about this, for example, I think that there's some move for it in Europe. If the European Central Bank would only just have the good grace to mark its existing conventional portfolio securities, conventional and unconventional because they yield nothing, but never mind. But the otherwise conventional portfolio securities, just transform them into zero coupon perpetuals. The European community's debt load would be lightened instantly. And I could see S&P and Moody's conferring like an instantaneous upward revision, like from everything's rated now probably what A to AA, maybe AAA plus. What's beyond AAA plus? Something. But so anyway, that's for your consideration, ladies and gentlemen. DelanceyPlace.com, the Code of Hammurabi, and the coming thing: student loans, European debt, Japanese debt, what have you, debt forgiveness. Yeah, doesn't yield anything anyway. But Evan, I'm going to turn the SPAC discussion over to you and Julian. You found out about Julian, and he kindly agreed to your invitation. And you, Evan, are the inventor, the progenitor of the slightly well-known Grants SPAC Index. But I think it's probably good for all hands if you and Julian would tell us what the heck a SPAC is. So let's begin there.
Julian, so the question of the day, what is a special purpose acquisition company?
That's a great question, Jim and Evan. Thank you for having me on the show. Super happy to be here. So let's get into it. A SPAC, or a special purpose acquisition company, also known as a blank check. The way that it works is they'll do their own initial public offering, an IPO, say they raise about $200 million, and the IPO will generally be for units at $10 per unit. So notice how I said units, not shares. So typically a unit's made up of common shares and a fraction of a warrant. Some offer no warrants these days, just given the market's pretty frothy, and some offer a third, quarter, to even a full warrant. So units at $10, and hedge funds, kind of like the one that I run, typically subscribe to the IPO. And what the SPAC sponsor does with that $10 per share per unit that they raised, in this example, $200 million, that goes into trust. And in trust, they invest in T-bills, so perhaps the safest security out there, and they're not allowed to touch it until they complete a business combination. What the mandate of a SPAC is to complete a business combination, basically a merger with a private company over a set time frame, generally 2 years. And if they don't complete a business combination within that set time frame, then they liquidate and they pay out the trust value, which in this case would be $10 plus accrued interest, which I'm sure you guys know these days is very, very little. But nonetheless, that IPO capital is safe. In the alternative, where they do announce a business combination, and nearly 99% of SPACs these days are announcing business combinations, they put it up for vote, and 2 days prior to the vote, they give SPAC shareholders the option again to redeem for the $10 plus accrued interest. So it's an interesting security. I consider it a different asset class than common shares or just equities and fixed income, because SPACs basically have this embedded put, and if you subscribe to the IPO or buy the units in the secondary market, you do get this warrant kicker upside. Obviously, if a SPAC liquidates, the warrants are worthless. However, if they do a business combination and you choose to redeem your shares, those warrants still have a significant value. So it puts together an interesting risk-reward proposition such that if you buy these at the right price, i.e. like $10, sometimes you can buy them at a discount, in that you get equity upside combined with the downside of T-bill, or a scenario that I refer to as heads we win, tails we win big. So it's an interesting security. They have certainly proliferated recently and become topic du jour. So those are the basic mechanics. The other thing that I should mention, and I'm sure you'll want to talk about, is the notion of the sponsor promote. Now, the sponsor is the entrepreneurs, the management team that put together and steer these SPACs through their IPO and business combination. So they actually get as much as 20% of free shares. So it's a $200 million IPO, and it's 20% of the pro forma SPAC. So they could be issued about $50 million worth of stock in that scenario. Now, there's a lot of nuances to that. They could get negotiated down when a business combination happens. The other notion is that they don't necessarily get these shares for free. Like, because the SPAC can't touch the $10 in trust, they do need capital to fund their operations. So what the sponsor does is they put capital into the SPAC that we call at-risk capital, and they generally do it through private placement warrants, which are equivalent to the warrants offered in the units. And that's typically around 3% of the IPO value.
Julian, that's a very good and helpful background, but I'd like to dig in something that you said there, which is that when you invest there around $10 or less, you kind of have this dynamic where it's heads I win or tails I win. But I'd like you to contrast that with kind of the academic literature that shows if you look at most SPAC performances after mergers, they not only underperform the market, but they tend to underperform pretty largely. I'd love if you can kind of bridge between the optionality you get when you invest at $10 versus what happens after the mergers, where a lot of SPACs do trade pretty poorly.
Yeah, that's a great point, Evan. And so when I said that dynamic, the effective embedded put, or the interesting risk reward, note that disappears when the redemption date passes. So by the time the deal vote rolls around, I consider that a post-SPAC equity, and it can trade wherever. That embedded put at $10 plus accrued interest is no longer there. And so basically a SPAC changes asset classes 2 days prior to its deal vote because you no longer have your redemption privilege, and it can just trade like a normal stock. So it transitions from a SPAC with its unique risk-reward dynamic, and then a post-SPAC equity, which you indicated, academic literature does indicate that on a median basis, they tend to underperform. And I believe it follows somewhat of a Pareto distribution, similar to what you'd see in venture capital, where post-SPAC equities, you have a few big winners and a lot of losers. What we've been seeing lately is that a lot of earlier stage, more speculative story type stocks have been going public by SPAC, and so that could contribute to the return distribution of post-SPAC equities. And if you read up on additional academic literature, I believe Goldman Sachs put out a report that indicated that investing in pre-deal SPACs is where a significant amount or perhaps all the alpha is. And then on a post-SPAC equity basis, there's negative alpha, as you indicated, at least historically.
Well, one of the academic critics of the SPAC, or the students of the SPAC, is a fellow named Michael Klausner. He teaches law at Stanford. He's one of the co-authors of one of the more frequently cited academic studies of SPACs. And here is his quote in Bloomberg concerning SPACs. Quote, "It's very strange. I fundamentally don't understand why these things exist." Julian, why do they exist?
There is basically two factors in which has led to a tremendous boom in the popularity, and you can view a SPAC as kind of like a single stock VC or a single stock private equity fund. It's kind of the same thing, where you have a lot of alternative investment managers coming into the space, like Apollo, TPG, and hedge fund managers, Pershing Square, and VC firms, Dragoneer, Social Capital. And so they're putting together basically one deal fund, and that's basically what a SPAC is. And why they're so popular these days, confluence of two factors. So number one, on the demand side, if you look at the equity markets over the past 20 years, you've seen a dramatic decline in listings in the U.S. from like 8,000 to about 5,000 shares, as capital has grown significantly in the private asset space. And one common approach to public equities is that public market investors are very short-term focused, only care about quarterly results, and you must be profitable and making the numbers. But I think what really turned this on its head was the SPAC that did a transaction with Virgin Galactic, which was a very early stage company, highly speculative and wasn't going to earn revenue a number of years out. And that proved incredibly popular in the public markets. And we really haven't seen public market investors get access to earlier stage companies, pre-profit and sometimes even pre-revenue. And that is proven to be of extreme demand, specifically mostly by retail investors, but some institutional investors as well. So there is this inherent demand for earlier stage companies. I consider them a Series D, level of VC type opportunities that are pursuing to go public prior than where they used to. Like if you look at Uber or something along those lines, they went public after most of the growth was out of the company, and they're fairly mature. However, a lot of the companies going public via SPAC these days are earlier stage, and there's a tremendous demand for them from public market investors. Then on the supply side, on the flip side of the coin, more and more sponsors realize the tremendous economics of these sponsor promote, which is unlike we've ever seen in investment management, to get where you can make tens of millions, hundreds of millions of dollars off of a one deal transaction. There is a sponsor that could make $1 billion today this year in compensation off their SPAC. So that is something very notable, and it's really led to a boom, just the confluence of those two factors, both supply and demand.
But let's put the boom in context, because last year there was $83 billion raised in the SPAC asset class, which was more than the asset class had raised cumulatively in all previous years, and that was through 248 IPOs. So far in January alone, 74 SPACs have raised $21 billion, which means that just in a little bit less than 3 months, we'll take out last year's record, which was bigger than all prior years. Is there a certain point where this asset class just grows so much and does deals that are more marginal on basis that it ends up burning investors and it kind of shrinks the asset class for years going forward?
Yeah, it's certainly a concern. It's just gotten into quite a bit of frenzy, as you indicated. In January, we are way above 20 billion. If we rewind back to October, there was 18 billion in SPAC IPOs. I never thought that record would get broken, but here we are. And January's not even finished, and we're at 21 billion across just 74, 75 issues. And it's incredible, the amount of SPACs outstanding. There's currently 345 in the market, of which 286 are looking for a deal. In addition, there's nearly 100 active S1 filings. SPACs plan on coming to the market. So, I would have thought the limit to the market was less than where we're at today. 345 SPACs, that is a lot. So who really knows where this market is sustainable? I always thought kind of in the $2 to $4 billion per month, certainly not north of 20 billion, which is exceptional. So if we go prior to the boom that started in July of 2020, we're seeing kind of $3 billion on average in SPAC IPOs. But contrasting that, you've seen many firms turn SPACs into a business line, a manufacturing operation. If we take private equity shops, like Apollo, Fortress, TPG, et cetera. There's certain business lines, leverage buyouts, credit, infrastructure, et cetera. They all now have SPAC business lines where they're churning out, 3 to 4 per year. And I expect that to continue. So it is, there's a lot going on, and the market just moves so fast that, it's tough to know what to expect, but it certainly has expanded far greater and far faster than I would have ever imagined.
Well, isn't it odd that year after year, passive strategies, index funds have taken share from active management, and we've heard over and over again that active management is dead and decomposing, and that we all ought to just send our money to Vanguard and be done with it. Along comes the SPAC, otherwise known as a blind pool, and these promotions constitute the active management of a portfolio diversified to the N of one, right? One name, one promoter, and we have heard from Julian himself that after the period when the search begins in earnest for that one, it is to be hoped, home run of a single acquisition, that's when time comes to get out, no? Is that fair characterization, Julian, of what you said? So
well,
you get out.
Yeah, and so the way that we affect the strategy, that I can walk you through what. No.
I just want to clarify. Okay, so let me finish this one thought. So it seems to me that this is demonstrably loony Now, what have I missed? Is it something more than that? Doesn't this almost beg to be entered right now into the realm of popular delusions of the madness of crowds, or not?
Yeah, perhaps there's some truth to that, and it really depends on the market environment. Because with the proliferation of SPACs, I'm hearing from sponsors that valuations are rising tremendously because they're all kind of chasing after the same targets, and if you're a target,
right,
then you can capitalize on that dynamic. However, I view that similar to what you'd see in venture capital. There's these hot startups where VC firms are all trying to throw money at them, and certainly they'd capitalize on that as well. And you see in the IPO space, I mean, SPACs are no different than some of these IPOs, whether it be DoorDash or Airbnb, where they're doubling overnight. Like, they know that valuations are rising and they're capitalizing on that. So it's not isolated within the SPAC market.
Yeah.
I think this market dynamic is viewable all over.
It's part of the everything bubble. Julian, I follow you on Twitter, and I think everyone should. You go by the handle The Arbitrage King, and you're at Julian Klymochko on Twitter. A week or two ago, you said we also passed another record, which is, for the first time ever, no SPAC was trading at a discount to net asset value. Is that still true today? And if so, what is like the average premium that SPACs are trading to the liquidation value? Like, how much premium are people putting into this asset class?
Yeah, so that's a really good point, Evan, because, our strategy is to arbitrage these things, and we used to be able to buy them. If we rewind back to last spring, all SPACs were basically trading at a discount where we were buying at $9.50, $9.70, where you had a great IRR to redemption and the worst case scenario, redemption or liquidation, and then upside optionality on vote. And that's really been the key to the strategy, is this tremendous upside optionality where they announce a business combination. If you look at any of the hot sectors, electric vehicles, EV charging, things of that nature, and you see this tremendous, what we call a SPAC pop, where it'll trade up 50%, 100%. And so the market has started to price that in. And, if you're lucky enough to get access to the IPO at $10, you see them all instantly trade up. And I checked, I put out our monthly SPAC monitor. It's going out today. And there is zero trading at a discount, zero SPACs trading at a discount out, 345. And that is unprecedented. We follow this market closely, and we do trade in the secondary market and try to buy these at a discount just as a straight cash rate of return type arbitrage trade. And currently there are zero, which is disconcerting, of course. And now average premium has risen to 24.3% above the trust value. And that's the average SPAC, which is, extremely frothy in my opinion. If we rewind back to the fall, things were pretty frothy back then. The average premium nearly reached 15%, which was a record at the time. IPOs were getting oversubscribed, or allocations were getting cut back. And then 6 weeks later into early November, the average SPAC premium actually declined to around zero. So just 2.5 months ago, the market was pretty balanced in terms of supply and demand. However, that has flipped. Even though we've had this tremendous flood of supply, as you indicated, record IPO issuance, the likes that we've never seen, like an order of magnitude larger, it seems like demand has just increased exponentially more, where IPOs in the previous frothy environment being 3 to 5 times oversubscribed. I think everyone we're looking at is like 10 times oversubscribed. On average, SPAC IPOs are trading up kind of 6 to 7% on the first day. And this is for a blank check company with just cash. But the reason is because market participants are starting to price in tremendous upside optionality, the SPAC pop on deal announcement, where on average deals announced, SPACs that have announced business combination in January, they're trading at an average unit premium north of 60%. So that means a unit that you bought for $10 in IPO, if they did announce a business combination this month, then on average they're trading north of $16. But that being said, it's an extremely frothy environment, and there's this tremendous built-in premium of 24.3%. So the average SPAC is trading at $12.40, call it. But that introduces some material downside for the strategy. So guys like us, we're very concerned with the risk and volatility built into that, and are kind of, actively trying to pare back risk just to deal with that. But who knows? I mean, you never know how high valuations will go, and, it's certainly a crazy environment, but you're seeing it in many pockets of the market too.
Hey, Julian, I see this morning there's a new ETF to invest in SPACs. It's called Morgan Creek Capital Management SPAC ETF. Is this the first such thing, or one of many?
Well, one of many, Jim. So I run a company called Accelerate. We actually launched the first SPAC-focused ETF early last year. Accelerated Arbitrage Fund ETF. It actually trades up in Canada on the TSX, so we're kind of like the odd man out. Yeah, so that's been around for almost a year, and after that, we have seen 3 more come out in the U.S., and, it's a topic du jour. SPACs have become very popular.
Yeah.
I never thought it would become popular.
So, way back,
I think we'll see more of them for sure.
Way back when, Julian, there was we had funds, hedge funds, and then there were funds of funds, right? And at length, I've forgotten what year this might have been, 1999, maybe even 1998. We had a front page headline of grants that barely fit across 3 columns. And the headline read as follows: fees and fees and fees on funds of funds of funds. That was in response to the first funds of funds of funds.
Wow.
And I'm wondering if there's going to be an ETF of SPACs. It's a thought, isn't it?
Yeah, I mean, it could be a good business plan. Are we going to see the grant SPAC ETF of ETFs or what?
Julian, what you described right now in the market almost sounds like an inventory stocking cycle, where people are overscribing to IPOs because they know they're not going to get their full allotment, which means the IPOs are able to kind of upsize, and then once the deals start trading, people start buying into them more. In a typical commodity cycle, say if automakers are worried that there's not going to be enough steel, they might order 120% of what they need because they know they're not going to get their full order filled, which leads to massive price spikes. Then once supply responds to this, you get massive price declines. Do you think there might be something similar in SPACs where we have so many people trying to pour in and they're actually over allocating towards IPOs and other funds like this because they know they can't get their full fill, but once they do, we could be on the other side where all of a sudden demand drops off while supply keeps ramping up?
Oh, 100%. That is most certainly happening, and the fills these days are atrocious. The SPAC IPO market is the most competitive I've ever seen it. As I indicated, pretty much every deal 10x oversubscribed. A similar but less extreme dynamic played out fall of 2020, where we started to get cut back significantly on IPO allocations, and then the market softened into November. Then soon we're getting 100% fills, and then by early November, 80% of SPAC IPOs were breaking price and trading down the first day. $9.90, $9.95, they actually can pick up good deals in the secondary market. So I think the current dynamic being 10x oversubscribed, and I think the vast majority of that are kind of fake orders where, someone wants 1 million shares, so they put in an order for 5 million because, they know they're going to get cut back 80%. That dynamic is most certainly being played out right now. So I view a lot of the oversubscription as, illusory and not necessarily real. And when the market does turn, and, it moves very fast, but it's cyclical like anything else, where you have a frothy market, then a downturn. And, at some point, I expect it to normalize, premiums to come back down, and IPOs to have a better allocations to more longer-term investors. I think what we've seen, just with the tremendous performance of the asset class, you look at any SPAC fund, and performance has just been pretty incredible lately, at least over the past 9 or 10 months. And so we have seen a lot of fast money hedge funds coming into the SPAC IPO market just because these things trade up like on average 6 to 7% on day one, and you're seeing about 1/3 turnover on the first day. So a lot of hedge funds that weren't in it 2 months ago are now in it, just buying to flip on the first day, and you see a lot of turnover on first day SPAC IPOs. And they're just kind of, scalping that 6 to 7%, largely to retail investors who are willing to pay that premium to cash that historically, didn't happen in less frothy market environments. And you have seen some of the, the pod type, very large hedge funds come in and they just take down massive IPO allocations because they pay the highest commissions on the street. So certainly the space has become quite crowded, I'd say. But I do expect that to normalize once you stop seeing that IPO pop, which is really just a recent phenomenon. Like I said, a couple months ago, that wasn't happening at all, except on the hottest deals. But once that reverses, then I think a lot of these guys will leave, and that oversubscription will come down significantly.
Julian, this has been really, really interesting. Ladies and gentlemen, you've been listening to Julian Klymochko, who is not only one of the earliest movers in the SPAC business, but also one of the sanest and most knowing voices about this phenomenon, which is really something. I mean, this is like, Evan, will you call this a thing?
I think it's a heck of a thing.
It's a thing, and I'm going to be on the lookout for this because I'm afraid that one of these days is going to be a great big smoking hole in the ground, and you don't want to step in that. no, you want to give that wide berth. But Julian, thank you for being with us. And Evan, as always, see you around the campus. And ladies and gentlemen, thank you for listening. This is Jim Grant on behalf of Current Yield, Grant's Interest Rate Observer of the Year.